Dinshaw Rani joins us now. Let's take our call. Let's take our conversation forward. What he makes of the earnings season. His PMS has given fantastic returns. How is he planning to continue the good work? Where is he picking up the spots in this kind of a market where right now markets are really talking about high liquidity, a lot of excitement in the IPO market and action in the mid-cap space. Dinshaw, good morning. Thank you for joining us. Last week was all about IT. Now, there is nothing new in terms of what IT companies have reported last week, but yet stock markets, or at least the IT bulls, were doing cartwheels.
Good morning, Nikunj. Thank you for having me on your show, and a very good morning to your viewers. It's always a pleasure to be on your show, Nikunj. So let me start with IT itself. I've been covering this sector from 2005 onwards, 16 years. And frankly, the kind of calls that has been, the results which came out were, as you rightly said, were more or less what was expected by analysts. But if you look at the calls, if you're listening on to the calls, analyst calls which are arranged by these companies, I've never heard them to be so bullish. These managements are conservative managements. It's a tough call to get a positive statement out of them. And for them to make statements like they're in a multi-year growth phase, they're lucky to be in an industry which is going to grow phenomenally well, haven't seen such kind of flows. These kind of statements you normally don't get out of a conservative management in the IT space, and they've all been doing that. So basically, we are in a very good growth phase in IT. You've seen the stocks re-rating along the way. And if this growth continues, which I believe will, which we really believe will, I think there's another set of re-ratings which may come about as such. But one more thing, Nikunj, look at it this way. If you were to look at the future, what do you see? You don't see any currencies in circulation. You just see, you digitize payments. You'll see a different way of the way you shop, the way you manage your home, or the way you buy, durables and stuff like that. All these are going to be aided by these guys. And one more thing which came out from these recent calls was that 5G is not only about telecom. 5G is going to change the way we live, the way we look at things, the Internet of Things. Everything is going to change because of 5G. So there's a huge market which is there for these guys to cash out on. And I think that's why they're so bullish, and that's why they're guiding it to go up this way as such. But one caveat here, I think most of these guys, the biggest cost factor for them is manpower. And most of these guys are seeing a pressure out there as such. In fact, the big guys also have seen the attrition slightly marginally moving up, and the smaller guys have seen it moving up further. And obviously the manpower cost also has moved up accordingly for them. So that is one way you have to look out for and probably see how that plays out. But more or less, I think they've got that covered. Looking at the way the pyramid is today, it's quite skewed toward the middle level. I think they want to broaden the bottom level of the pyramid. So that will itself skew the costs down if you look at it that way. So that's on IT.
So what is the best way of looking at IT? That there is scope for earnings surprise and P expansion more? Because I've always argued, Dinshaw, for the longest time, that we are giving chemical companies P multiples of 50, 60. We are giving P multiples of almost 80, 90 to consumer companies, which are also growing at 10, 15%. But we are still giving P multiples of 20, 25 to IT companies, which are growing, have strong margins, and are also doing buyback.
Actually, Nikunj, I thoroughly agree with you, because look at it also another way. Look at the ROCs, the efficient way in which they utilize their capital. They're at par with FMCG companies. On the terms of growth, they're far better than FMCG companies. I'm looking at FMCG because that's one area which we believe has got a lot of froth also. So maybe that could be a way of looking at it. And look at the top line growth from early teens. They got re-rated. I'm talking about the guidance from early teens. They re-rated it to mid-teens, and now they're closer to late teens. But I believe the year will end in 20s, if anything, if the way things are and if the way the order books are looked at. So they're far beyond all these FMCG plays in terms of top line growth, in terms of capital returns. And so why would they hold back their P's? That's why I'm also in the same camp as you, that I think there's a re-rating around the corner. Maybe another couple of quarters when you see these kind of growth rates kick in, maybe there's a jump up in ratings for these guys. And by the way, they were not so long back, they were quoting at 30 PEs when they were doing these kind of returns as such. So thoroughly agree.
Dinsha, hi there. Good morning. Avan as well joining in. How are you playing the entire consumption-related basket and a very wide net here, owing to the kind of changes that we've seen in consumer behavior due to the pandemic, be it even the FMCG counters as well as, the likes of tourism, aviation, multiplexes. How does one look to approach these from a portfolio standpoint?
So, Avan, good morning to you. On the consumer space, staples may do better because staples have, we're talking in after the second wave, right? We're looking at what happened in the second wave and then going forward, what we expect will happen. So we expect staples to do fairly okay. There'll be standard state kind of growth which will come in. And specifically this quarter will be a bit of a red for most of the durable companies. Be it, discretionary spend companies rather than durables alone. So be it say autos or say any consumer durable company. So that way, and that is mainly because of the second wave of COVID. But on a longer term basis too, we believe that discretionary spends have seen a disconnect from what had happened, say, in wave one. So if you're using the template of wave one to decipher wave two, I don't think that's going to work this time around. Discretionary spends will take a while to come back. Rural markets, if anything, again, are seeing a bit of pain. If sowing is anything to go by, Kharif sowing is down around 11.5-12% as compared to the area under Kharif sowing, as compared to what was last year this time around. So that itself is going to be another painful one. So I don't see the discretionary part of the consumer band doing too well as such. And that's why we are also in our portfolio, we're shifting from our middle theme, which is consumer facing, to the other two themes. So that's how we're playing this as such. And we believe this is a couple of quarters of pain, which is going to be there. It's not going to be one single quarter. This quarter anyway, everybody realizes that the good results are already out, and now it's a time for the bad results which will come in, and that will create a havoc with what is the analysts had estimated. I think there'll be a fair bit of downgrades happening after this quarter numbers are out.
I think safe to say, Dinsha, break it down however you want. Anything related to pharma has done very well of late. Now we're awaiting Glenmark Life's issue, for instance. The previous one was Gland Pharma, which has seen very phenomenal returns and return to shareholders quite significantly. How are you looking at the entire pharma basket from a valuation perspective? Are they justified?
So, okay, Avan, the point is that pharma on a longer term basis is expected to do well. In fact, if you see the latest issue of Economist also, where US is now targeting China in a big way, and all the global also looking at China. So there'll be a China plus one. India has been, actually, if you go back into history, which is not so some 10 or 15 years back, India was a net exporter of APIs. And we had to curb our exports because of cheaper imports coming in from China. So if we were to reverse the story, it'll a matter of time before India again regains its position in the world as an API exporter. But here you have to be selective. You can't be buying all the companies which are into APIs, because there are quite a few who have run up because the whole sector was running up. So you have to be cautious there. You have to see whether their pipelines are good enough for them to manage those kinds of valuations. Because ultimately, after a few quarters, it will be normalized growth, right, which will kick in. And to sustain that normalized growth, do they have the pipeline? So one has to be very careful here. And that's why we're being very selective in this space and very picky in our choices in pharma, though the overall trend is expected to be bullish here. So.
Right. Dinsha, Pankaj also joining into the discussion. We've spoken about IT, we've spoken about pharma. These are traditional names, keep growing. At least they don't fall, because the earnings growth has some visibility. What about the metals pack? Are you surprised by the sort of cyclical move that you have seen? Do you expect gains to be made even from here on, or you expect that, they could see a slight bit of correction?
Morning, Pankaj. We were fair skeptics in metal earlier, but then we realized it's not a cyclical move. It was looking like more of a structural move because the demand came in a big way, and there was no step up of supply which was happening. In fact, China started curbing its exports and stuff like that. So we realized that this is a longer term play which can be played out, and we did enter quite a while back into the metal space. But I don't know, Aman. I mean, if you're looking at it from now on, it'll be steady gains. I think the bulk of the pop was done and over with. From here on, it'll be more of a steady play, which will come in per se, because ultimately, what are metals? I mean, they basically use at the consumer end, right? And if the consumption doesn't kick in for the next couple of quarters, which we believe is going to be the case, I don't think the run-up is going to be that sharp as such. Already, I mean, the steel companies are controlling their price hikes per se, given the kind of opposition they've seen from auto companies or consumer companies, discretionary companies. So that way, so I think it's done and dusted. The big pop from here on, it's going to be steady returns.
Right. Some of the other names, the capex plays, the likes of L&T, some large infrastructure company. We have an infrastructure listing today as well. What do you make of some of these sectors which have which have just started to move? And really, if you look at a 10-year return, they have hardly given any returns.
So, Pankaj, the problem with infrastructure sector is that they deal with government entities to execute their projects. I mean, at least thus far that has been the case, because the private sector capex hasn't kicked in a big way. When that happens, that will be a very big positive for the Indian economy as a whole, per se, not only for the infra plays. But the problem with dealing with government-owned entities or government entities is that, payments are always an issue. There's always inquiries happening. So we are very, 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 very selective in our play in infra. Though it's expected to do well over a longer term, but you have to be very careful on which players you choose. So we have, I mean, you mentioned L&T. That's one of the players that we own. And that's also because of a sum of parts story that is playing out in L&T with its major holdings and its IT plays per se. And the fact that he also has a major chunk in private capexes, which helps him mitigate whatever is happening on the public sector capexes per se. So you have to be, and anyways, very, very selective in his projects, also pickups also. So that way, so I think that is one particular company which has his finger in all the pies and infrastructure. So I think easier to play that than look at niche players within who may get impacted, or a smaller player who may get impacted with one payment going haywire as such. So we are very selective here.
The big theme the insurance markets are betting on is data, whether it is consumer tech, whether it is fintech, or whether it is what is happening to aggregators or platform companies like Zomato. How do you propose in this decade one can bet on this entire mega trend of data?
So Nikunj, here again, we are very cautious. We are not going overboard in buy now, pay later kind of plays as such. We're being very selective here because we frankly believe in India, though we have a probably 1.38 billion kind of a population, but actual consuming class is limited to 300 million odd people. And if any, and they're also 300 million out of that, I think probably the 100 million would be the creme de la creme of consumption per se as such. So anything which is going beyond that 10, 20 million kind of a play of consumers, there's a limit to which how much he can grow, unless he's, you mentioned about food tech companies and stuff like that. But there again, it's more of the fact that if you look at globally, there's only mainly all major markets have two or one player in the markets as such. In India, you have only two players. So there'll be a fair bit of scarcity value which will play out. And that's a millennial play rather than anything else. So millennial consumer play rather than anything else. So I think that should be an insulated pocket. Otherwise, others, you have to be very careful. You have to just see what their addressable market is, how much saturated they are in that market, how much competition can come into that market. Like fintech and all, there's no end to it. I mean, you've seen a company being promoted every day. In fact, the other day I read an email that working from home, the couples in Bangalore start a fintech every day out there. So it's that kind of a play happening here. So you have to be very selective in that space, I suppose.
Someone's told me that is also happening in the stock market industry also. Every day working at home, new AIFs and PMS are mushrooming now.
Right. I agree. It's a spillover there also, I suppose. And especially, if you see the kind of savings that have come up, I think India has seen its saving rate moving up by 5%. So obviously that money has to go somewhere, and maybe the stock markets here from here on. So maybe that could be one way.
So where are we headed in next 12 months, given that the joker in the pack is still third wave? What we don't know, we don't know. So let's not talk about it. But you will definitely see a fear of inflation coming back. The base effect would have got diluted by second half of this year. And somewhere markets will like to take a realistic view of valuations also.
Right. So Nikunj, our belief is that maybe the large caps may not be that impacted. But if you see the way the mid caps and small caps in particular have run up, in fact, the other day I was reading a report from a leading brokerage. They said that the small caps are at the valuations are 40% premium to their long-term averages, which is like an area where they always correct down as such. Maybe they'll hold for a while. A second point that we would like to highlight here is look at history. I mean, we normally tend to ignore history, but if you consider the months where such huge inflows happened into the NFO market, I mean, rather the suck out of money happened from NFOs in a particular month, which is like in this particular month of July. If you look at the months in the past, say September of 10 or a September of 17 or a March of 18, the correction has been fairly sharp and fairly aggressive in the mid-cap, small-cap space. So that is one area that one has to be cautious about. Again, I mentioned that this quarter, you will see a lot of downgrades happening. I don't think in fact, it started in the March quarter itself with the upgrade-downgrade cycle was more or less 1:1. But this time around, I think it will be skewed in favor of downgrades rather than being at parity as such. So that itself will make a bit of an impression on institutional investors too. So there is a fair bit of caution at our end also in this regard, and that's why we're being very selective in our plays. And if you notice, our large cap weightages have moved up in our portfolio as compared to the mid cap and small cap, where we cut down some weight and moved into the large cap space. So that's how we try to play this volatility.
Okay. Dinsha also wanted to understand what your outlook is when it comes to the entire metals basket. Owing to the way we've seen the price movement, how do you see the chain reaction of that as well playing out to sectors that are closely linked to metals as a raw material?
So, Aman, good question. Actually, that's one of the reasons why we believe that there'll be downgrades happening in this quarter. So if you see the auto companies badly impacted because of metals, they have not been able to pass on the price hikes even for BS6 vehicles, leave alone the hike that you'll see in that is one. Discretionary plays, again, they'll be impacted because of the input costs moving up. And not only metals, all commodities across have moved up. Crude, there's a slight breather going forward, but that's about it, a slight breather. I don't think it's going to be a big breather for us at $75, $70 It's going to be a stretch. So I think that is one play that is going to impact the markets going forward, per se, in terms of the fundamentals coming off to an extent. So.
Okay, so and if we were to talk in particular about some of the auto ancillary companies as well, you have seen a fairly decent performance kick in within this space. There's a lot of focus going forward as well. How are you looking at the entire auto ancillary space?
You said it yourself, EVs. I mean, that's a big elephant in the room. You can't ignore that, right? So our call is that by the end of this, rather by 28, 29, you'll see that decade rather, you'll see that EVs will start outselling ICEs. So that way you have to be very selective, even in the auto ancillary space. I mean, you have to be very clear that when you're buying these guys, are they a 1 year, 2 year story, or they're a longer term story if they're on the EV space as such. So you have to be very careful there. And frankly, I mean, when we do our DCFs, we always tend to put a value of 2-3% as terminal growth rate. But in the case of autos and ancillaries, you have to have a negative terminal growth rate to, provide for this EV, which is going to come in. And if you tell me that these guys will get into EV, it's a different mindset altogether. EV is not about manufacturing. It's a platform that you're creating rather than a car that you're manufacturing per se in an assembly line. So that's not going to work for them. And anyway, there's increased competition in EV. So we will see more players coming in on the EV space. So you have to be selective here. We're not too bullish on that space anyways.
Right. Dinshaw, when we talk about EVs, how would you look at the Ola news that has come over the weekend? 1 lakh booking, 500 is the reserve price. Of course, it's just a reserve price. It's not that, people may go ahead and convert it. But there is an acceptance in the market, which was a doubt earlier. And that is why one has to be cautious on how this space moves ahead.
Yes, specifically in two-wheelers, Pankaj, because two-wheelers, it's going to be very easy to convert to EV. I mean, you see a lot of them on the road anyways. In fact, a couple of years back, I'd gone to Varanasi and three-wheelers out there were all EVs, which are running in the town. So I was quite surprised to see it that way. But the fact is the adoption is going to be very easy for a two-wheeler or three-wheeler. Auto space may take a while because it's much more complicated than a battery which you can pick up and you can charge at home as such. So that way. So I think two-wheelers is going to be a long call. In fact, Avan talked about ancillaries. I think any ancillaries dealing with two-wheeler space has to be very clear on where he's heading in the future, because there the transition is going to be very fast. It's going to be very rapid.
Right. Just when we talk about the markets of India versus the rest of the world, there has been a resilience as far as Indian market is concerned. You could call that DIs have started to buy, retailers have started to buy, or maybe earnings are showing some recovery. Maybe that's why. But what is your sense? You think India markets will be resilient to minor shocks in the global markets for now?
So not really. I don't think that's going to be. I mean, we tried to play that in 2008 and got slapped on our faces, both ways. But it is going to be a function of what the global markets are. Positive is that FIIs have disproportionately allocated money to India in a big way. Yeah, just to give you an example of this year itself, calendar year to date, FIIs have pumped in $7.5 billion, $7.6 billion, if I'm to be more precise, and out of the MSCI emerging markets, they've withdrawn $29 billion. So it's a disproportionate inflow to India. And as you rightly mentioned, that is because they also believe that India has this DII, which provides liquidity, or retail, which is quite aggressive in its spends per se as compared to other emerging Asian markets. And plus, there are a few sectors which are only privy to India, like the consumer-facing pharma or IT. So that way they disproportionately get our money, we get our money. But off late, in fact, I think month to date, we have a negative figure in FII as such, which is an area of concern. So if that continues, there'll be an issue. I mean, frankly, I mean, FII is not going to pump in money in India if they're losing across the globe as such. So it's going to be a call on the global markets also, which will impact Indian markets per se.
We've discussed a plethora of sectors with you. Thanks very much, Dinshaw, as always, for taking the time out.